Welcome back, friends. So, we see the US markets on a roll. Last week, we had blockbuster results from Nvidia, which propelled the US markets, the NASDAQ sharply higher. And the general belief is that even after phenomenal run up in Nvidia, there is more to follow. Well, there are, on the other hand, pessimists such as Jeremy Grantham, who believe that a 20 to 30 percentage correction in the US stock markets would not be completely out of place. There are artificial intelligence stories, and anybody and everybody who is in the AI field is benefiting in this ecosystem. NVIDIA results, no doubt, phenomenal, yet one could see a little bit of slowdown in some portions of its business on a quarter to quarter comparison as per the guidance they have given. There are many factors which can cause uh, a downturn in the US markets as we go forward. Before I mention the reasons, I would like to caution you and mention that there is a little steam more left in the rally, but when the tide swings, it'll be a very, very nasty one. And it's happening, going to happen pretty soon, as far as the analysis we have done. Even a mild economic slowdown could send stocks plunging. Investors are, for the time being, pricing in over 100 basis points of rate cuts from the US Federal Reserve, according to the CME FedWatch tool. Economists have been surprised by the resilience over the past year, with the growth estimated to fall 2.9 percentage for the current quarter, according to Atlanta Fed economists. Number two, continuing unemployment claims have hovered close to 1.9 million since the start of 2024. Now that shows that well, the claims are not going down. The job additions do not seem to be commensurate. Third, the credit card debt is has increased 1.13 trillion dollars over the fourth quarter, which means that the consumers will soon move into the credit limits. And consumers have been the major engine of growth of the US economy for quite some time. So anything that tends to reduce the consumer spending because the consumers have reached their credit limits can definitely have an impact on the US economy and thus its stock prices. Number four, inflation isn't likely to get close to the 2 percentage target that the US Federal Reserve seems to be envisaging anytime soon. Prices have definitely cooled down from their highs in 2022, yet a good amount of money printing and a huge amount of $2 trillion dollars plus that were let out by the government during the pandemic since the President Biden took charge can definitely leave some inflation effects. Now, these inflation effects take time to percolate through the US economy and can definitely have commensurate effects. The current run up in the stocks are based on the strength of seven mega cap tech stocks, uh, very much referred to as the Magnificent Seven. And there's a great amount of excited betting on when the Fed will lower interest rates. If inflation is not going to come out in a hurry, as we envisage, because the effects do last for over 2 years from the time that the money printing takes place. And for the whole thing to percolate through the economy is not an easy task. When the Federal Reserve will lower interest rates is something that has been at the center stage of many investors. There were expectations about March, now that has got rolled over into June. Any further rolling over can definitely have a deep impact. You have the PCE data coming in this week on Thursday, and that can also have commensurate impact. Many tech stocks, especially those that haven't been able to back up their valuations with earnings, may crater as the economy uh, shows some signs of a downdrift. There are great signs that what we are seeing today can be commensurate with 2001 dot com boom and dot com bust. A surprising overlay of the Cisco chart on the NVIDIA chart shows some very useful comparisons. Now, many people think that this boom is here for real, and yes, the internet boom at the time of the Cisco stock boom was also there for real. In fact, Cisco has continued its growth beyond 2001, yet, and Nvidia would as well, and neither is the AI boom here to go down in a hurry. At the same time, you will find that evaluations which are commanding seem to be quite scary. They definitely do not justify based on the growth rates that we have at hand. A little slowdown in the growth rate in the AI sector will tend to bring down a lot of the bottom line earnings, and this can have an immediate impact on stock prices. This can become a vicious cycle and bring down the rest of the market with it. At present, the biggest frenzy, investor frenzy, has been in the AI space, and also as far as the pharmaceutical are concerned, the weight loss drugs, which seem to have caught the fancy of investors. So why isn't the normal, the bread and butter, the cookies, the others not moved so well? And why are investors looking at these new exotic spheres of investment and generating alpha and enthusiasm just in these areas? Because the growth is slowing down in other spheres. So they're looking at opportunities and they're hoping against hope that, hey, it would be AI, it would be these blockbuster drugs, the weight loss, the drugs of anti obesity, that will bring the markets up. And when that does not come to transpire, that will be the point of time that you will see signs of an initial slowdown that can go and impact other spheres of the US economy and thus the stock markets as well. There is a very big understanding that the US elections are around the corner. And at this point of time, the American government would definitely like the interest rates to be on the lower side. That having been said and done is not being borne out by the data that is emanating at this point of time. Inflation looks to be something that would not go down in a hurry just because, as I explained, the effects of the uh, printing of money by the US government takes time to percolate. That's why you are seeing that although there is a great amount of enthusiasm that yeah, they have definitely come down, but yet you see time and again they then turn out to be quite resilient. In this scenario, it is extremely difficult to imagine that Fed will come in a hurry and cut interest rates. That combined with lowering growth across the US economy can definitely impact stock market valuations, and I would like you to be careful. Whereas there is still some steam left in the rally, when the tide turns, and it's going to turn very, very soon and very sharply, it will take down the entire market with it. To get to know where we are headed from here on over the next few days, weeks, and months, please do join our Prime or Prime Plus Telegram groups. You can do that by WhatsApping us on 982-086-1044. Alternatively, you can also email us at globalmoneyinvestor@gmail.com. It is globalmoneyinvestor@gmail.com. Happy investing and have a great day and week ahead. Take care. Bye bye.